My name is Dennis, and today we're going to be talking about the Fed's recent policy decision to raise interest rates by 0.5%. Why hasn't this been done in about 2 decades, and what significance does it have? What is it going to mean for us as investors, for households, for the actual economy? Let's waste no time. Let's get right into the content today. Before we do, if you like content like this, leave a comment down below letting me know what you think. Make sure you subscribe for more content like this. Hit that thumbs up button for me. So the Federal Reserve just recently raised interest rates by 50 basis points, and this is the first time that they've done such a significant jump in over a decade. And the reason why they did it is to try to fight inflation. Now, the Fed has done this before where they've raised it by 0.25 or 25 basis points as far as the interest rates go. 50 basis points of 0.5% jump, something that we haven't seen in decades, doing it to get ahead of the curve, to cool down inflation. And now we have inflation for a couple different reasons. A lot of what we're seeing right now stems from the pandemic. The pandemic, which is still ongoing, but when this story is told years and years down the line, what did COVID do? There's going to be obviously a medical, a death side that's going to, be the main thing, because lives lost is more important than anything that we're really talking about. But there's going to also be other sides of it. What did it do to society as far as making us go towards technology? What did it do to supply chains, jobs, the way that people viewed things? All of that is a story that's going to be told. A lot of this started from COVID. So with the actual pandemic, things went into the lockdown. The supply chains got all the way messed up. They're still screwy. All the stimulus spending. So now we have money. We're going to go out and spend money, or we're just going to spend money, cope with the things that's going on. But in all of that, there's not a lot of it because it's not being produced the way that it was before. Now we got to jack up the prices. Other things that have happened as well, as far as the actual bird flu that's going on as well, poultry, if you've seen egg prices, chicken price, things of that nature, cars, chip issues that have gone on, so there's less cars. So just this perfect storm that's happened, and now the Federal Reserve has no choice but to respond. And in all honesty, this is going to take years and years to fix. Now, this isn't a fix what just happened. This is an appropriate measure. You send a shock to the actual market to actually cool down the actual demand, because now borrowing is going to get less attractive. Interest rates are going to be up. You're going to see interest rates that maybe we haven't seen for the last X amount of years, that a lot of people are no longer familiar with. Mortgage rates 5, 6, 7, 8% now. When will they get there? If they continue to raise rates, if they do another 0.5, another 2, or regularly do this, we might see mortgage rates that a lot of borrowers haven't seen, cool down that market. Other areas as well. Credit card, borrowing with a credit card might be more expensive, so less people will do it. Just really but doing this on a balancing scale, because you don't want to cool it off to where it shuts off and you slow down the recession. Places aren't making money because people aren't buying, and now people are getting in late. You don't want to necessarily do that, and that's why they have such a hard job. They have macroeconomics on the biggest scale that you could think of. All the data is there, but what is the right decision to make? That's a job that they have. That's a tough job that they have. But what they did with this, really sending a shock, sending a message to markets with this 50 basis point rate hump. And let's make no mistake, this was an aggressive move by the Federal Reserve. This was an aggressive move. It sends a message. It's risky. You risk a recession, but it was also a necessary thing. So now that we know why they did what they did, let's talk about the significance of it for America and for the world in general. This policy decision by the Fed was absolutely necessary. It had to happen to get the job done. Doing it by the 50 basis points. Is it aggressive? Yes, it's a very aggressive, it's a bold move, but it's a necessary one. The alternative, if you don't get ahead of the actual curve with inflation, you're risking things like hyperinflation. And when it comes to hyperinflation, prices begin to skyrocket, people can't afford things. What happens? You start to get a whole bunch of poverty. The middle class becomes impoverished because you weren't able to control it. What happens when you get a whole bunch of poverty? You get a whole bunch of crime. Not necessarily bad people. Now all the bad people come out because everybody's in poverty. No, but when you're in an impoverished state, a lot of times you start to see an uptick in crime. Look at a country like Venezuela. When they had things that happened there, hyperinflation that happened, the price increases, you started to see on the actual news, crime, all these bad things. Why was it happening? Because people were starving on the actual street trying to provide for themselves. It's not to say that people are necessarily bad, but when put in a bad situation, you're gonna get more of people doing bad things because of it. And that's why the alternative, if you didn't get ahead of it, because inflation has been running hot for a while now. The 25 basis points, they were good. The first time, do it again. Might still see some increases, 25 basis points. That might become a regular thing that starts to happen. But sending this shock, this 50 basis point, here goes a big increase in interest right now, just to send that shock. I think that was the actual pilot. That was the key. Doing the 50 basis points was an actual key to make sure to send the right message, to send the right shock, to do what was necessary to get ahead of the actual inflation curve. You don't want to necessarily chase it. You want to be able to control it. And there are times, and this is why the Fed actually meets, where you can constrain too much. You could try to do too much and you could actually cause a recession. We've all heard the term of Fed-induced recession. You could get things like that to happen as well. So you have to be careful. I've heard them discuss that, another 50 basis point jump isn't out of the realm in the future. Will it happen next time around, next month? Don't really know, but I think it was an appropriate thing. There was the actual whispers of the 0.75% jump. Now that I think would have been too aggressive. That would have been too much. And obviously they have information, a lot more data than I do, than the majority of us do. I think they realize that as well. The 50 basis points, it sends the good shock. 25 basis point jumps here and there, that makes sense as well. But in the current environment where we are right now, I think they did the right thing. Now, what is it going to do? It's probably going to slow down borrowing. You're going to see mortgage rates, car loan rates, credit card rates. If you're in business, your business loans, business lines of credits, all of those things might be up a little bit. It's going to slow down borrowing. It's going to try to cool down the actual demand until the supply can finally catch up. It's not going to necessarily happen over the next couple months because there's also issues with the supply chain outside of this. It's not going to necessarily stop things. It's going to slow down growth, but it's the right thing to do because of where we are in the actual cycle.